Hi, this is Michael O'Leary, By the Book Taxes, here with another in a series of tax video blogs on IRS collections. What I'm going to talk about today are IRS liens and levies. I'm going to give you some terminology and try and clear up some misconceptions, misperceptions on liens and levies. Excuse me, and also give a couple of examples. So I want to differentiate the difference between a lien and a levy. A lien is when the IRS makes a claim upon a taxpayer's property. What they're saying is you owe the IRS a certain amount of money. You haven't responded to their attempt to collect the money. So we're going to protect our interests by placing a lien on your property. Now, I want to be very specific when I say this. Liens are not placed on specific assets. I have people call me and say, the IRS placed a lien on my house. They actually don't place a lien on a specific asset. They place a lien on your social security number, and that lien attaches to all your assets, both present and future. And it's very important to understand how this works. So if you're an individual who owns a home and lives in a certain town, the lien will be sent to the town hall in the town, in the county where you reside. If you have a business and the lien is against the business, the lien will be sent to the town hall in the town, in the county where the business is. Or if, for example, if you have an investment rental property, the lien will be sent to the town in the county where that investment rental property is. So the key thing is the lien itself is not being placed on your specific asset. It's placed on your social security number, and it attaches to all your assets. So that's a lien, and it's a claim against your property because you have a debt. A levy is different. A levy is an actual taking of money or property to satisfy the debt. The two most common levies that you see are what's called a regular levy, where due to lack of response to the IRS collection letters, the IRS sends a levy notice to your bank and cleans out the bank account and puts that money toward the debt. That's what's called a regular levy. There's also a continuing levy, which is most commonly known as a wage garnishment. So the IRS may send a levy notice to your employer, and the employer must comply and basically deduct a certain amount of tax each pay period from you and send it to the IRS. Now, the first levy, the one-time levy, literally is that's it. They go in, they take the money out of your bank account, whatever's there, whether it's $10 or 10,000. If you owe more than that, they can just take it once and that's it. In order to take more money from you, they would have to issue another levy. Whereas the continuing levy is just like the word says. They establish it against your W-2 wages, and the money comes out every paycheck. So there's another thing that's very important to understand with levies. With liens. There's two different things. There's the lien itself, and then there's what's called the notice of federal tax lien. Most taxpayers don't realize that they have a lien on their property because the IRS never notified them. And the rule is the IRS doesn't have to notify. A lien may arise automatically once tax has been assessed, a billing notice has been sent to the taxpayer, and after it's like 14 days or 20 days, if the taxpayer does not pay the balance due, a lien may arise. It's called a silent lien in that you're not notified and you don't have to be notified. The second piece of this is what's known as a notice of federal tax lien. Those are two different things. So what the IRS may do is actually issue a notice of federal tax lien, which makes all potential creditors out there, all potential people who could lend you money, it makes them aware that you have an IRS lien against you. This tends to make bankers very nervous when it comes to you. If you want to take out any credit cards, refinance your mortgage, the lending companies, the banks they get very nervous when they see IRS loans. So what can you do? The two most common things I hear is that somebody will come to me and say, look, I want to refinance my mortgage, but I can't because I have an IRS lien, or I want to sell my house, but I can't because I have an IRS lien. That's not true. There are ways to work around IRS liens. I'm going to give two basic examples. So let's say you own a house, but you want to refinance it, and you're afraid that you can't because there's an IRS lien. There's something called lien subordination. You can actually subordinate your IRS debt. You can ask the IRS to take a step back and let the mortgage lender get ahead of them in line as far as the credit queue that you have. So the IRS will do this. You have to fill out a form and send them all the documentation associated with the refinance, the appraisal, everything, the rate, the monthly payment. They will do this. They will agree to have the lien subordinated and allow you to do the refinance if, for example, you're getting a lower interest rate, which is going to give you more free cash flow each month, which will enable you to pay the IRS more money and thereby clear the debt sooner. So they will do that. And that's I don't think that's a very difficult thing to do, as long as you have all the proper documentation and you can show that, for example, refinancing the mortgage, I'm going to save $500-600 a month, and I'm going to give that extra $500 or $600 a month right to the IRS, and I'll pay that debt off 2 years, 3 years sooner. The IRS will do that. The other situation is where you want to sell your house, but you're concerned about having an IRS lien. There you can request what's called a lien discharge. And there's two different scenarios with the lien discharge. The one scenario is where, based on selling your house, you'll have enough equity that you can pay off the IRS debt in full. The other scenario is where you have some equity in the house, but what you'll be receiving is not enough to pay off the IRS in full. You can do either. The IRS will accept either. Once again, there's an IRS form for discharging a federal tax lien, and you have to submit all of the paperwork associated with the sale, the contract, the appraisal, everything, all of the all of the closing documentation you would normally get at a closing. You request a payoff amount from the IRS, you send them all this documentation, and let's say you could pay it off in full. Let's say you owe the IRS $80,000, but you're getting $150,000 upon the sale. As long as you can provide them with certified checks at the closing, so they get the money to pay it off, you don't. So instead of getting 150,000, you get 150,000 less what you owe them. They will do that. They will discharge that. On the other hand, let's say you owe them 80,000 and you're only going to clear 50 from the sale. Same process. As long as they get everything that you could get, they are willing to discharge the lien. And you sell a house, they get the 50,000, you walk away with zero. You can't have a lien, have a debt, sell a house, not pay them in full, and then walk away with cash. That's not going to happen. If all you have is less than what you owe them, they'll take what you're getting, and that'll be that. They will discharge the lien. Okay, so if you have years of unfiled tax returns, owe the IRS money, have liens, and are concerned about refinancing or selling your house, please give me a call. I'm going to share my screen here. So here's my contact information, Michael O'Leary, Norwalk, Connecticut. There's my cell, my fax, my email, my website, and here are the services that I provide. Income tax preparation, 1040s and 1041s for estate and trusts, and then pretty much the menu of all the tax resolution options: installment payment agreements, offer and compromise, currently not collectible due to hardship, innocent spouse. If there's tax debts left over from a prior marriage, I can also help you get prior year penalties abated and refunded possibly, and obviously help you with liens and levies. So that's it. Give me a call. I'm happy to help.